Hello, this video is a demo class on strategic financial management. I will be giving a demo on a few concepts of capital budgeting. Okay. So, capital budgeting. This capital budgeting is a tool in financial management which is used for making long-term investment decisions. Used for taking long-term investment decisions. Okay. So, what and all is available in this tool will be the payback period, discounted payback period, net present value, profitability index, IRR, modified IRR, ARR, and so on. Okay. So just let me brief you on the payback period concept. What is this payback period? This payback period is the time taken to recover the original investment made in the project. Time taken to recover the original investment made in the project. This is the meaning of payback period. How is this payback period computed? This payback period is computed as original investment divided by annual cash flows after taxes. Original investment divided by annual cash flows after taxes. This formula has a logic, and this formula will apply only when the cash flows are uniform. Only in case of uniform cash flows will this formula be applied, and this formula has a logic. I will tell you the logic of this. See, suppose an investment in machinery is made worth rupees 10 lakhs, right? And because of investing in this machinery, the organization purchases the machinery. Organization purchases a machinery for rupees 10 lakhs, right? With this much machinery which is purchased, the organization will produce and sell goods. Produce and sell goods, generating a revenue, right? So, assume the cash flows after taxes is rupees 2 lakhs. These are just random numbers. Assume cash flows after taxes is 2 lakhs. Because of investing 10 lakhs in a capital asset, every year the organization is going to generate an after tax cash flows of rupees 2 lakhs, which means how long will it take to recover my original investment of 10 lakhs? It will take me 5 years to recover my original investment of 10 lakhs. Say this 2 lakhs is uniform. How did I get that 5 years? That 5 years I got as the purchase cost, which is the original investment, divided by the annual cash flows after taxes. So now let me tell you what this cash flows after taxes is. This cash flows after taxes is earnings before depreciation and tax. From that, subtract depreciation, which is an allowable expenditure on the capital asset for tax purposes. You get earnings before tax. From that, you subtract tax, you will get earnings after tax. To that, you add back depreciation, you will arrive at cash flows after taxes. Now, there may be a question on why is the depreciation subtracted at the top and added back at the end. This depreciation is subtracted from earnings because only on the net earnings will I be paying taxes. This depreciation is an allowable expenditure for tax purposes. So I calculate the earnings, which is net of depreciation, and only on that net earnings I pay taxes. I get earnings after tax. But the amount of cash flows which is yielded by the project is not earnings after tax. It is inclusive of depreciation, which will give me my cash flows. Why? Because the depreciation does not have any outflow. There is no spending for depreciation. It is a non-cash expenditure. It is an allowable expenditure for tax purposes. That is why I subtract it in the beginning. After availing the tax benefit, I add back depreciation to know the cash flows after taxes. So the formula which I gave you, original investment divided by annual cash flows after taxes. This formula will apply in case of uniform cash flows. For an example which I gave you, suppose 10 lakhs is the investment made in machinery, 2 lakhs is the cash flows which is generated every year. In such case, 5 years is the payback period. What if the cash flows are not uniform? If the cash flows are not uniform, you will find cumulative cash flows and apply the statistical technique called interpolation to find the payback period. What does payback period tell you? Payback period tells you the time taken to recover the amount of original investment. This payback period has a major drawback of ignoring the concept of time value of money. That is why came into picture the discounted payback period.